What is up, everyone? This is Marcus with your not so weekly tax tip. So let's talk about the $500,000 homeowner tax break. Now, there is a large tax break that allows you to exclude up to $250,000 in capital gains if you're an individual, or up to $500,000 if you are married. Now, that is on the sale of your personal residence. But by making the assumption that this gain exclusion will always keep you safe from tax, it can be a big mistake. And here's what you need to know. So, to qualify for the capital gains tax exclusion, when you sell your home, you need to pass 3 hurdles. Number 1, that is your main home. It can be a traditional home, a condo, a houseboat, a mobile home. But main home also means the place of primary residence when you own 2 or more houses. Number 2, it needs to pass the ownership test. You must own your home during 2 of the last past 5 years. Now, number 3, you also must pass the residency test. You must also live in the home for 2 of the past 5 years. Now, there are some additional quirks to know about, including this. You can pass the ownership test and the resident test at different times. You may also use the home gain exclusion once every 2 years. And you and your spouse, you can be treated jointly or separately depending on the circumstances. So here is when you need to pay attention. So you have been in your home for a long time, right? The longer you live in your home, the more likely you will have a large capital gain. So longtime homeowners, you should check to see if you have any prior capital gains tax problems before selling your home. Let's talk about having 2 homes in one. So newly married couples with 2 homes may have a potential tax liability, as both individuals may pass the required test on their own property, but not on their new spouse's property. So prior to selling these individual homes, you may need to create a plan of action that reduces your tax exposure. All right, let's talk about selling home after a divorce. So property transferred as a result of a divorce is not deemed a sale of your home. However, if the ex-spouse that retains the home later sells the home, it may have an impact on the amount of capital gain exemption that's available. What else? Say you are helping an older family member. So special rules apply to the elderly who move out of a home and move into an assisted living or nursing home. So prior to selling the property, it is best to review options and, of course, the related tax implications. Now, you didn't say you don't meet the 5-year rule. In some cases, you may be eligible for a partial gain exclusion if you are required to move, say for work, say for disability, or any unforeseen circumstances. There are a number of other exemptions to the home gain exclusion rules. This can include foreclosure, any kind of debt forgiveness, any inheritance, and even partial ownership. But the bottom line is this. The key to obtaining the full benefit of the tax exclusion is in retaining good records. You must be able to prove both the sales price of your home and the associated costs you are using to determine the gain on your property. So keep all sales records, any original home purchase records, improvement cost, and other documents that support your home's capital gain calculation. Now, as always, if you need any assistance in doing any of these things, you have any other questions, just let me know. Until next time.